To what do you attribute such a tough time on Wall Street today? What was keeping stocks down?
Oh, I would have expected some sort of a pullback ahead of earnings season, given the magnitude of the run. So I wouldn't make too much of a 60 basis point down move. But I suppose you could toss some trade concerns in there. On balance, though, we've had a tremendous run, and some consolidation would probably be constructive, actually, so that we don't go into earnings season right at the highs, given that, the difficulties we're going to see in at least a handful of names anyway.
We're seeing Caterpillar drag on the Dow today, Boeing as well, and that has been the case for the last few weeks. Binky, to what do you attribute needing to regain some of this steam in the market?
Sure. So some of that is just exactly and only the trade headlines, and there is the backdrop. Though I would argue this is very, very old news, which is that, global growth is going to be lower. I think that makes a lot more sense to talk about in Q4 rather than now. I would say the question is very different now. The question now is, is Q1 going to be the bottom in U.S. and global growth?
When we look at the Q1 earnings and where we might see some softness, potentially the banks, where they come out, we're going to start seeing those come out on Friday. Where will you look for signs of optimism, Barry?
Well, for me, the key issue, there were two concepts I'd like to see through earnings season. One is, or three actually. One is that revenue growth remain at 5% or better. I don't really believe there's going to be the kind of margin contraction that is being discussed. I think it'll be highly concentrated in a handful of names. The second is that the banking sector continue with the return on assets and return on equity jump that they saw in the fourth quarter, which I think is a consequence of a big or significant change in asset mix from government securities to private sector loans. That was a quantum leap to get ROE well above 10%. So that would be issue number two. Issue number three is, what does capital spending in intellectual property, software, the cloud look like? Because that's what's really been driving CapEx, not the equipment. It was much stronger in the fourth quarter than any economist expected, given that the softness in the core durable goods orders. So if we hear that from tech companies, that spending has continued to pace, and that was a big beneficiary of the tax bill. For me, then the outlook is really pretty solid for the rest of the year.
Binky, what's your view of earnings season? Is it going to be a positive or negative catalyst for the U.S. market?
So I think you should keep in mind that out of the last 24 earnings seasons, so the last 6 years, 21 have been positive for the market. So average returns are pretty solid 3%. But I would argue, in terms of the information we get, in terms of the aggregate numbers, it should not really be a market mover. So if you look at the bottom-up consensus, it says, minus 2.5% growth, but earnings in the U.S. always beat. So that's about a 3.5%. You do the arithmetic, and it's slightly positive numbers. If you look at our top-down model, it says pretty much the same thing. So, from an earnings reporting and an earnings beating point of view, we expect really basically an average quarter. But I would say the number one thing that you want to be looking for is the fact that big global growth scare in the last quarter of last year. And the market looks, pretty fairly priced for current growth, but the S&P 500 is somewhat unique in the sense that it provides basically, a window into what I would argue is the number one issue for global growth, which is really Europe. Pretty significant share of sales for the S&P 500 come from Europe. And why Europe has slowed so much, and Germany in particular, and German manufacturing in particular, is probably the most important question.